JP Morgan has put together an outstanding investor's guide, delving deep into the economic landscape and stock market. Let's delve into the most intriguing aspects of this guide and explore how to make the most of it. Let's get started. JP Morgan Chase is the largest bank in the United States and one of the largest in the world. Periodically, it releases a market guide, a data-driven guide rather than one based on opinions. Here, we see the evolution of inflation in the United States. We have the overall inflation in blue and the core inflation in black. Core inflation excludes energy and unprocessed food products, whose prices are quite volatile. The idea behind core inflation is to eliminate volatile factors to get a more realistic view of price movements in a region or country. We see that overall inflation is at 3.1%, above the central bank's target of 2%, and core inflation is even higher at 4%. So, inflation persists for now. To contain inflation, the Fed and other central banks raised interest rates. The Fed's rates are between 5.25% and 5.5%. Here, we're provided with future interest rate forecasts. Although predicting this isn't foolproof, the most crucial aspect is this long-term interest rate forecast of 2.5%. This is because the Fed considers the neutral interest rate to be between 2% and 3%. The neutral interest rate is the one that neither boosts nor slows down the economy, it simply lets it progress at its pace. So, in the next 10 or 20 years, it's most likely that the interest rate will average between 2% and 3%. There will be times when it's within this range, times when it's above, and times when it's below. But we can conclude that the further above the interest rates are from this range at a given time, the more likely they'll be lower in a few years, and the closer they are to 0%, the more likely they'll be higher in a few years. Note that we say more likely, not certain. Additionally, even if interest rates are high, they can continue to rise for some time before falling. The real interest rate, which is simply subtracting the yield of the 10-year bond from inflation. Currently, the real interest rate is about 0, as a 10-year U.S. bond offers a yield equal to inflation. Looking at the current yield curve, we notice that it's highly inverted. Typically, the longer the maturity of a bond, the higher its yield. However, this hasn't been the case for the past year or so. An inverted yield curve indicates that investors expect a decrease in interest rates. Historically, whenever the yield curve inverts, a recession follows. During recessions, central banks usually cut interest rates to stimulate the economy. Another way central banks stimulate the economy is by buying bonds. After the pandemic, central banks bought many bonds to incentivize the economy, contributing to the high inflation of recent years. In 2023, they started to unwind some of these bonds. The U.S. government's accounts, the income and expenses for 2023. We see that expenses exceed income by $1.7 trillion, and the interest expense in 2023 was $659 billion. In 2024, the interest expense will be even higher, as government debt must increase by $1.7 trillion to offset that income expense difference. We see how every year the government spends more than it earns, and balancing these accounts will become increasingly difficult as debt grows, leading to higher interest costs. Here, we see how government debt has increased relative to GDP. As for municipal and state debt, it's slightly decreasing, while household debt relative to income is quite controlled. Since the 2008 crisis, families' and businesses' finances have become more prudent, not just in the U.S., but also in most Western countries. We see that the unemployment rate is at 3.7%, its lowest point in 50 years. In Spain, the unemployment rate has been declining since 2012. Other labor market indicators include the number of unfilled job openings, worker resignations, and layoffs. After the labor shortage in 2022, when there were 12 million unfilled jobs in the U.S., it has decreased to 8.7 million, still a high number, along with the number of people resigning from their jobs. This contrasts with what happens during a crisis, where layoffs increase, people cling to their jobs, and the number of available jobs plummets. Let's now turn to the oil market. Here we see the evolution of the price of a Texas barrel since 2003. We can see when the price plummeted during the pandemic and how it surged between 2021 and 2022. Interestingly, the best time to invest in oil is when prices are at their lowest, not at their highest. We also see the daily consumption of millions of barrels of oil worldwide, which has surpassed the 100 billion mark again this year, as well as production. Now, let's see JP Morgan's outlook. They mention the drop in inflation and the prospects of a more flexible Federal Reserve policy, leading to talk of a soft landing rather than a forced recession and a bear market. The main indicators point to a growth slowdown but not a collapse. There's still a risk of recession in 2024, but even if it happens, it's likely to be mild, especially because the Federal Reserve provides ample liquidity to the banking system through backdoor channels. They emphasize that it's crucial to note that stocks usually bottom out long before the peak of economic difficulties. We can see the last recessions here and the months that passed from the beginning of the recession until stocks bottomed out, much earlier than other economic indicators. This means investors can't act based on the economy alone because the stock market anticipates economic trends. The only exception was the dot-com bubble, where the stock market continued to decline for a few more months. The challenge for investors in 2024 is as follows. 1. The damage to public sector finances from high debts. 2. Markets already discount a very soft landing. And 3. The high contribution of mega-cap stocks. In 2023, the profits of mega-cap stocks grew by more than 30%, while the rest of the companies in the S&P 500 saw their profits fall by an average of 5%. This disparity led to a 24% increase in the S&P 500, primarily driven by the top 10 companies, which surged by 62%. This dominance of the top companies means that the weight of the top 10 companies in the S&P 500 is at its peak. Considering all these factors, it seems that 2024 will be a year of growth slowdown in GDP, single-digit profit growth for companies, and single-digit returns on average in the S&P 500. So, the S&P 500 is expected to rise by between 1% and 9% in 2024. Or at least, that's what JP Morgan tells us because that's what people want to hear. What will happen to the stock market a year from now can't be predicted. By the way, when JP Morgan says that it's a challenge that the markets already discount a very soft landing, it's because, according to them, the market expects the best-case scenario. If a soft landing occurs, it won't be news, and it won't cause the stock market to rise. However, if anything else happens, it could be a catalyst for the stock market to fall. Now let's dive into the most interesting parts of the guide. The guide also shows the relationship between consumer sentiment regarding personal finances, the economic situation, etc., and stock market returns. We can see the S&P 500's return in the 12 months following both peaks of confidence and troughs of pessimism. When confidence was very high, the S&P 500's return was 3.5% after 12 months, whereas it was 24% when confidence was very low, as was the case in 2022. The guide also displays the S&P 500's returns each year, represented by the black bars, and the largest decline during that year in red. We can observe that almost every year, there's at least a 10% drop, presenting an opportunity to buy at a much lower price. Another interesting graph in the guide shows the S&P 500's performance since the Fed's last rate hike in each rate hike period. We can see that in the months following a rate hike, the stock market almost always rose, except in 1999, 2004, and 2005. The Fed stopped raising rates in those years, and the stock market continued to rise for another year and a half before the financial crisis hit, leading to a decline. As it's an election year in the US, the guide also shows that whichever party governs has almost no relevance to the stock market's performance.